Silicon Valley Bank, or SVB, started with a simple idea: serve the unique needs of tech startups. Traditional banks often shied away from these risky ventures. SVB saw an opportunity.
Founded in 1983, the bank quickly became a fixture in Silicon Valley. It offered tailored financial products and services to startups and venture capitalists. SVB's success was tied to the success of its clients. As Silicon Valley boomed, so did SVB.
The bank's focus on a niche market proved to be a winning strategy. SVB developed a deep understanding of the tech industry. This allowed them to assess risk and identify promising startups. They became more than just a bank. They became a trusted partner to entrepreneurs and investors. This close relationship with the tech ecosystem fueled SVB's rapid growth in the late 20th and early 21st centuries. SVB's growth accelerated as it supported some of the biggest names in tech. Companies like Airbnb, Zoom, and Tesla all banked with SVB. The bank's success became intertwined with the tech industry's relentless rise. As these companies grew, so did SVB's deposits and profits.
SVB expanded its operations globally, following its clients into new markets. They opened offices in tech hubs around the world, from London to Bangalore. SVB's strategy seemed infallible. The tech industry was booming. Valuations soared. Money poured into startups.
Yet, beneath the surface, a quiet risk was building in SVB's balance sheet. The bank's investment strategy, heavily reliant on long-term government bonds, would soon prove to be its Achilles heel. SVB's investment strategy was simple but risky. They put a large portion of their deposits into long-term U.S. government bonds. This strategy was considered safe when interest rates were low. Bonds offered a steady, if unspectacular, return.
However, this strategy ignored a fundamental principle of finance: interest rate risk. When interest rates rise, the value of existing bonds falls. This is exactly what happened in 2022. The Federal Reserve, in an effort to combat soaring inflation, began aggressively raising interest rates. The value of SVB's bond portfolio plummeted. This created a large unrealized loss on their balance sheet.
Initially, this wasn't a major problem as long as SVB didn't have to sell those bonds. However, the tech industry was slowing down. Startups, facing a tougher fundraising environment, began withdrawing their deposits. The perfect storm hit SVB in early March 2023. The bank was forced to sell a large portion of its bond holdings at a significant loss to cover the deposit withdrawals. This sparked panic among venture capitalists and tech founders. News spread quickly through social media, triggering a classic bank run. Depositors rushed to withdraw their funds, fearing that SVB would collapse. Within 48 hours, SVB, once a pillar of the tech industry, was seized by regulators.
The sudden collapse sent shockwaves through the financial system. It served as a stark reminder of the interconnected nature of the global economy.
The collapse of SVB holds many lessons, particularly about the importance of risk management and diversification. It highlights the dangers of relying too heavily on a single industry or asset class. Gap 3S. The collapse of SVB offers several key lessons for the financial industry. First, the importance of diversification cannot be overstated. Relying too heavily on a single asset class or industry can be disastrous. Second, effective risk management is crucial. SVB's failure to account for interest rate risk was a critical oversight. Finally, transparency and communication are vital during times of crisis. The rapid spread of information through social media played a significant role in the bank run. By understanding these lessons, other financial institutions can avoid similar pitfalls in the future. Gap 3S. In the wake of SVB's collapse, the tech industry and financial markets faced a period of uncertainty. However, the resilience of the tech ecosystem soon became evident. New financial institutions emerged to fill the void left by SVB. Startups adapted to the new environment, finding innovative ways to secure funding. The lessons learned from SVB's downfall led to stronger risk management practices across the industry. While the collapse was a significant setback, it also paved the way for a more robust and resilient financial system. Gap 3S. The future of tech banking is poised for transformation. With the lessons from SVB's collapse, new players in the industry are focusing on innovation and risk management. Fintech companies are leveraging technology to offer more personalized and efficient services. Blockchain and cryptocurrency are also gaining traction, offering new ways to manage and transfer funds. The tech banking landscape is evolving rapidly, and those who can adapt to the changing environment will thrive. The collapse of SVB, while a cautionary tale, also serves as a catalyst for positive change in the industry. GAP 3S. The rise and fall of Silicon Valley Bank is a story of ambition, success, and caution. It highlights the dynamic nature of the tech industry and the importance of sound financial practices. As we look to the future, the lessons from SVB's journey will continue to shape the financial landscape. By embracing innovation and maintaining a focus on risk management, the tech banking sector can build a more resilient and prosperous future. Thank you for watching this cautionary tale of Silicon Valley Bank. GAP 3S. The collapse of Silicon Valley Bank did not only send shockwaves through the tech industry, but also had significant repercussions on the global financial market. Experts agree that the sudden downfall of a major financial institution like SVB served as a stark reminder of the interconnectedness of modern economies. GAP 2S. Dr. Emily Johnson, a financial analyst at Global Finance Insights, notes, "The failure of SVB was a wake-up call for many investors and institutions around the world. It underscored the need for stringent risk management and diversified investment strategies." GAP 2S. According to a report by the International Monetary Fund, the immediate aftermath saw a 4% decline in global tech stock indices, with ripple effects felt across various sectors. The uncertainty caused by SVB's collapse led to a temporary tightening of credit conditions, affecting startups and established corporations alike. GAP 2S. Furthermore, central banks in several countries had to step in to stabilize their financial markets, injecting liquidity and reassuring investors. This incident also prompted regulatory bodies to re-evaluate existing frameworks and consider new measures to prevent similar crises in the future. GAP 2S. Professor Mark Thompson from the University of Economics adds, "The SVB collapse highlighted vulnerabilities in the tech banking sector that many had overlooked. It has since prompted a global dialogue on how to create more resilient financial systems." GAP 2S. In the long term, the lessons learned from SVB's downfall are likely to lead to more robust regulatory practices and a greater emphasis on financial stability. While the immediate impact was challenging, the global financial market is poised to adapt and emerge stronger. GAP 2S. As we reflect on SVB's story, it's clear that its impact extends far beyond Silicon Valley. The global financial community continues to learn and evolve, striving for a future that balances innovation with stability. GAP 3S. The collapse of Silicon Valley Bank didn't just send ripples through the financial markets, it also triggered a wave of regulatory changes aimed at preventing such crises in the future. Financial regulators around the world took swift action to tighten oversight and implement more stringent risk management frameworks. GAP 2S. GAP 2S. Jane Smith, head of the Financial Regulatory Authority, comments, "The SVB incident was a wake-up call. We realized that the existing regulations were not sufficient to handle the complexities of modern banking, especially in the tech sector." GAP 2S. GAP 2S. Following the collapse, several countries introduced new regulations focused on enhancing transparency, improving capital requirements, and enforcing stricter stress tests for banks heavily involved in the tech industry. GAP 2S. GAP 2S. Financial analyst Robert Harris adds, "One of the key changes we've seen is the requirement for banks to maintain higher liquidity reserves. This ensures they are better equipped to handle sudden withdrawals and financial shocks." GAP 2S. GAP 2S. The U.S. Federal Reserve, for instance, has now mandated more frequent and rigorous stress testing for banks with significant exposure to the tech sector. Meanwhile, the European Central Bank has introduced new guidelines to enhance the monitoring of tech-related financial activities. GAP 2S. GAP 2S. Dr. Linda Martinez, professor of financial law, explains, "These regulatory changes are designed to create a more resilient banking system. They aim to strike a balance between fostering innovation and ensuring financial stability." GAP 2S. GAP 2S. While the immediate aftermath of SVB's collapse was challenging, the regulatory overhaul has been a crucial step in rebuilding trust and stability in the global financial system. These changes are not just about preventing another SVB, they are about creating a future where the financial system can support innovation without compromising on security. GAP 2S. GAP 2S. As we move forward, the lessons learned from the SVB collapse will continue to shape the regulatory landscape, ensuring that the financial system is better prepared for the challenges of the future. GAP 2S. GAP 2S. The story of SVB serves as a powerful reminder that in the world of finance, constant vigilance and adaptation are key to maintaining stability in an ever-evolving landscape. As we reflect on the journey of Silicon Valley Bank, from its early successes to its dramatic collapse and the ensuing regulatory overhaul, several key takeaways emerge. First and foremost, the importance of robust risk management cannot be overstated. Banks, especially those deeply intertwined with the tech sector, must maintain high liquidity reserves and undergo rigorous stress testing to withstand financial shocks. Secondly, transparency and regulatory oversight are crucial in maintaining trust and stability in the financial system. The swift actions taken by regulators around the world underscore the need for continuous adaptation to the complexities of modern banking. Finally, the SVB incident serves as a stark reminder that innovation and security must go hand in hand. As the banking sector evolves, it must strike a delicate balance between fostering technological advancements and ensuring financial stability. Looking ahead, the lessons learned from SVB will continue to shape the future of tech banking. The regulatory changes implemented in the wake of its collapse are designed to create a more resilient and secure financial system, capable of supporting innovation without compromising on security. As we navigate this ever-evolving landscape, it is crucial for all stakeholders, banks, regulators, and customers alike, to stay informed and vigilant. By staying informed, we can collectively contribute to a more stable and secure financial future. Thank you for joining us on this journey through the story of Silicon Valley Bank. If you found this video informative, please like, subscribe, and hit the notification bell to stay updated on future content. Together we can build a safer and more innovative financial world.